It begins with a silence so profound you'd never hear it happening. It's the sound of a $20 bill being slid into a pocket, a few coins removed from a tray. A minor expense, barely worth the ink it takes to record it. But in the high-stakes theater of corporate finance, what we perceive as insignificant is often the spark of a catastrophic fire. Over days, months, and even decades, the money simply evaporates. This is petty cash leakage. It is the invisible drain, the slow-motion heist that 99% of organizations never see coming. But tonight, we go beyond the balance sheet. We peel back the layers of the petty cash box to reveal the multi-million-dollar secrets hiding in plain sight. You are watching Corporate Secrets, and the truth about the small change is about to cost you everything. In an era of blockchain, instant wire transfers, and encrypted digital wallets, the petty cash fund is a strange, analog relic. Yet, it exists in almost every major corporation on the planet. It is the grease for the corporate machine, the quick fix for taxi fares, emergency repairs, or the last-minute meeting coffee. It was built on a foundation of convenience, but more importantly, it was built on trust. In the world of investigative intelligence, trust is not a virtue. It is a critical vulnerability. While million-dollar transactions are guarded by layers of approval and biometric security, the petty cash box often sits in a desk drawer, protected by a $5 lock and a handwritten log. It is the most liquid and simultaneously the most neglected asset in the building. A silent invitation for those who know how to look. The danger isn't just the cash itself, it's the human element of the tracking. Manual entries, smudged ink, and paper-based logs create a dense fog of war. In the corporate world, if a transaction falls under the $50 or $100 mark, it often bypasses the heavy-duty scrutiny of internal audits. It is classified as immaterial. But immaterial is perhaps the most dangerous word in the auditor's vocabulary. It creates a massive blind spot where small-scale manipulation can breathe and grow. Auditors are trained to hunt the elephants, the multi-million-dollar embezzlements. But they often miss the termites, the tiny, relentless eaters that bring the entire structure down from the inside. In these logs, a 4 becomes a 9. A postage expense masks a personal dinner, and the leakage begins its slow, steady drip. It starts with a subtle inflation. A taxi ride that cost $12 is recorded as 18. A lunch for 20 becomes 25. The difference is so small it doesn't trigger a single alarm, yet it represents 100% profit for the claimant. We call this the inflation game. It is a psychological threshold, a test to see what the system will swallow. If a supervisor signs off without a second glance, or if the original receipt is never requested, the boundary of what is acceptable begins to shift. It's not about the $6, it's about the realization that the fence has a hole in it, and once that hole is discovered, it will be exploited again and again until it becomes a gateway for systemic theft. The leak is no longer an accident, it is a strategy. When inflating real expenses is no longer enough, the next act is fabrication. In our world of high-resolution printers and template software, a genuine receipt can be manufactured in seconds. Generic receipt pads, available at any corner store, are filled with fictional vendor names, plausible dates, and just the right amount of wear and tear. These are the ghosts in the corporate machine. Transactions for goods that were never purchased and services that were never rendered. They are buried in the petty cash pile, waiting to be converted into tax-free, untraceable cash. To a busy manager, they look like any other piece of paper. But to an investigator, they are the breadcrumbs of a systemic failure. The paper trail is physical, but the reality it represents is a total fabrication, a lie hidden in plain sight. The true power of petty cash leakage isn't in the size of the theft, but in its frequency. A single $1,000 withdrawal is a massive red flag. But 20 separate $50 withdrawals over the course of a month, that is simply business as usual. This is the drip feed strategy. The fraudster takes small amounts repeatedly, ensuring that no single transaction ever breaches the threshold of suspicion. They wait for shift changes, busy month ends, or periods of high executive turnover to make their moves. By staying under the radar, they transform the company's petty cash box into a personal, high-yield ATM. It's a low-stakes gamble with a high-frequency payout. And because the amounts are so petty, the psychological guilt is minimized. They tell themselves it doesn't matter, but the math says otherwise. In any investigation, the silence of the records is often louder than the evidence itself. Documentation gaps are the primary breeding ground for leakage. Missing receipts are casually explained away as lost in the mail or the vendor's machine was broken. Incomplete logs with vague one-word descriptions like sundries or travel provide the perfect cover for siphoning. When the rules for documentation are relaxed, the opportunity for fraud expands exponentially. An organization that doesn't demand a receipt for every dollar is essentially giving away its capital. These gaps aren't just administrative errors, they are active invitations. In the world of petty cash, if it isn't documented, it didn't happen. But the money is still gone, leaving nothing but a hole in the budget and a shadow in the books. The final line of defense is reconciliation, the simple act of matching the cash on hand to the physical records. But in the reality of the modern corporate world, this is often a low-priority task, pushed to the bottom of the pile and delayed for months. When reconciliation is irregular, errors and thefts become impossible to trace. The trail goes cold. By the time an auditor notices a shortfall, the person responsible may have been promoted, transferred, or left the company entirely. Weak reconciliation is the oxygen that keeps the fire of petty cash leakage alive. Without a rigorous, independent, and frequent check, the custodian of the cash is essentially auditing themselves. And in the world of financial crime, that is a guaranteed recipe for disaster. The shield is broken. Individually, these leaks are tiny, the cost of a sandwich, a taxi ride, or a ream of printer paper. But when you scale this across a global enterprise with thousands of employees and hundreds of departments, the numbers become staggering. A $30 leak twice a week per department can easily snowball into hundreds of thousands of dollars a year. This is what we call death by 1,000 cuts. Because no single cut is fatal, the organization doesn't realize it is bleeding out until the total loss is finally calculated. It is a silent, systemic drain on the bottom line, a hidden tax paid to inefficiency and a lack of control. The math is simple, but the impact is profound. Small amounts add up. Every hour, every day, every single time. Let's look at a real-world scenario. Meet Rahul. He is a trusted administrator at a regional branch of a global logistics firm. He's been with the company for a decade. He knows the systems, he knows the people, and most importantly, he knows the weaknesses. Over 3 years, Rahul began inflating his petty cash claims by just $40 a week. It seemed like nothing, the price of a few office lunches. But Rahul wasn't alone. Across 20 different branches, others were following the same unwritten rule. When an investigative audit finally caught up, they discovered a cumulative leakage of $2.4 million over 5 years. This wasn't a heist. It was a slow, systemic siphoning. And the source wasn't an external hacker. It was the very people the company trusted the most. So why does this theft go undetected for so long? The answer is simple: the priority trap. In the high-pressure world of corporate risk management, petty cash is at the absolute bottom of the list. Management is hyper-focused on cyber attacks, supply chain disruptions, and multi-million-dollar contracts. A few $100s in a metal box is seen as noise, something that doesn't move the needle. This lack of attention is the fraudster's greatest ally. When there is no tone at the top regarding small expenses, the culture of compliance begins to rot from the bottom up. If the leaders don't care about the small stuff, the employees certainly won't. This cultural failure is the true root cause of leakage. Detection fails because we simply aren't looking. The second reason for this failure is the reliance on manual, antiquated processes. Paper-based tracking is inherently prone to error and manipulation. It is difficult to search, impossible to analyze in real time, and alarmingly easy to destroy or alter. In a manual system, the only way to find fraud is to physically touch every single piece of paper, a task that most organizations simply do not have the time or resources for. Manual systems are the dark ages of accounting. They increase the risk of both honest human errors and calculated, intentional theft. Until petty cash is dragged into the digital age, the leakage will continue to flow, hidden behind a wall of inefficient and outdated bureaucracy. The darkness is where the money disappears. But the signs are always there, if you know where to look. Investigative intelligence tells us to watch for the fingerprints of leakage. Frequent small withdrawals that stay just below the approval threshold. Duplicate receipts used across different departments or time periods. A persistent pattern of lost or missing documentation. And perhaps the biggest red flag of all, a custodian who is strangely protective of their system and resist any form of independent reconciliation. These are not just coincidences, they are the warning signals of a system under attack. By training managers to spot these micro-anomalies, an organization can stop the bleed before it becomes a fatal wound. The key is to treat the small transactions with the same investigative rigor as the large ones. The lesson is powerful and undeniable. Control over the small expenses is the foundation of preventing massive corporate losses. By moving from manual cash boxes to integrated digital spend management systems, organizations can gain total, real-time visibility. Prepaid corporate cards, digital receipt capture, and automated reconciliation remove the opportunity for human manipulation. When every dollar is tracked the moment it is spent, the leakage stops instantly. This isn't about policing your employees. It's about protecting your organization's future. It's about building a culture where every cent is valued. Because a company that cannot manage its petty cash will eventually find it cannot manage its destiny. Transparency is the only cure for the silent drain. But here is the final, chilling twist. The real risk to your organization isn't just the single petty cash box sitting in your headquarters. It is the hundreds, perhaps thousands, of small cash points scattered across your global operations. In remote warehouses, regional sales offices, and international subsidiaries. Each one is a potential leak. Each one is a hidden drain on your resources. When you multiply a petty loss by the scale of a modern multinational enterprise, you aren't looking at a minor expense anymore. You are looking at a systemic vulnerability that could be costing you millions every single year. The question isn't whether you have a leak. The question is, how many are you choosing to ignore right now? Keep watching the small things, because they are the big things. If this video opened your eyes, like, share, comment your thoughts, and subscribe to Corporate Secrets. Protect your organization. Stay vigilant. I'll see you in the next investigation.